Hi everyone, my name is Joseph-Antoine Migdelani. Today I am with Kareem Zakir, our portfolio manager, and welcome to our quarterly web capsule. So before we start, I just want to remind you that the reason why we do these capsules is to inform and educate you over the market, and we want to give you some tips as well on portfolio management. So let's go straight to the interesting topic, Kareem. Why don't you start with a quick market update?
So thank you, Joseph. Hello, everyone, and welcome. Third quarter this year has been really very good. And what's surprising is the month of September, which is known to be one of the worst months of the year for the markets in general, historically speaking. This year, it's been one of the best months of the year.
Good news.
Who would have known,
Yeah.
right? You don't see it coming, right? So it's been a great month, September. It's been a good quarter. The markets are at all-time highs. End of September, our portfolios are hitting all-time highs. The U.S. stocks are doing well. Canadian stocks are doing well. Bonds are doing great. And also precious metals have done extremely well, particularly gold.
Excellent. And let's go back to the fundamentals. And let me ask you, why are the market doing so well?
Well, there are really three fundamental reasons that come to light. The first one is skepticism from investors is still there. In other words, $6 trillion of cash is sitting in money market funds and has been sitting there since 18 to the last 24 months. Mm-hmm. So there's a lot of cash on the sidelines, which tells me there's a lot of skepticism. The second fundamental point is the Federal Reserve in the United States has cut interest rates by 50 basis points or 0.5%. This is always positive when interest rates go down. This makes cash less interesting, mm-hmm. which is resulting in the third point. The money is starting to broaden out into other stocks and other sectors of the stock market. The last 18 months, really the outstanding performers in the S&P 500 has been the Magnificent Seven, the high-tech artificial intelligence companies. It's beginning to broaden out to the other 493 stocks that make up the S&P 500. So these are three fundamental points that are playing in our favor.
Excellent. And what could we expect, or what could happen next?
October is a difficult month.
Mm-hmm.
It's the month known to have crashes. I remember the 1987 correction. It was devastating. However, because of the three fundamental points that I just mentioned, which we didn't have back in 1987, meaning tremendous liquidity is available, interest rates are headed down. In 87, they raised interest rates, and the fact that money is starting to propagate into other sectors. If there is a correction, I would think it would be short-lived because a lot of people are missing the rally and they want to get in.
Okay, thanks. And I keep meeting clients and they talk about recession. You probably heard a lot about clients talking about recession, and I want to ask you about recession fear. What are you saying about that?
Well, everybody often thinks when there's a recession, everything is going to go to hell in a handbasket. Mm-hmm. That is not the case, okay? I actually looked at numbers going back to 1957, and I noticed that when the Federal Reserve cuts interest rate, the first cut, which we had September 18th of this year, we had the first cut. In a recessionary period, the S&P 500 has a tendency to rise on average 8% during a recessionary period. And if we are in a soft landing, which I think we are, meaning that we may not even have a recession, mm-hmm. the markets have a tendency in that scenario to go up by 11%.
Wow.
12 months after.
Wow.
So I just want people to understand that risk is something we don't see coming. Okay? We didn't see 9/11 come. We didn't see the financial crisis come, and we really didn't see the pandemic hit, okay, in 2019. It's a bit like getting in your vehicle, your car. You know there's always a risk of an accident when you drive, but odds are you're going to make it to your destination. But when an accident occurs, you didn't see it coming. It's the same thing with the markets. So we prepare if there's risk. unfortunately, we don't see it coming. So I would just say to just continue as it is. Don't worry about the inevitable or whatever's going to happen. Stay the course.
Great. The other point, the U.S. election cycle, a lot of uncertainty. And I would like you to give us a little bit about history again over what happened during different presidency.
You know, Joseph, in our career, my career in particular, there's a lot of pessimism in investing. And I always try and help clients understand that pessimism actually could be an opportunity.
Right.
But I look back to 1957 with different presidencies, meaning what would you have done had you invested strictly during a Republican presidency and been in cash during the Democratic presidency, and vice versa, being invested in a Democratic presidency but staying in cash in a Republican presidency? Well, in the first scenario, had you just invested during a Republican presidency since 1957 to now, the S&P 500 would have averaged a return of 2.79% on an annual basis. Had you done the opposite and invested in the Democratic presidencies only, your return would have been 5.15% on an annual basis.
Okay.
And had you just simply stayed invested through both presidencies and never sold, your return would have been 8.08% on average. Goes to show, the lesson here is going to cash could be your biggest mistake.
Mm-hmm.
We don't know who's going to win the White House, and honestly, between you and me, it doesn't matter. That's short-term thinking. Long-term thinking is much different, and I know that in the longer term, historically speaking, the markets will continue to rise.
Super interesting. Thanks, Kareem. The last question is the question that I would like to ask you. What are you expecting for the end of 2024?
Well, for the three fundamental reasons I had discussed earlier, being that there's tremendous cash, interest rates are falling, and the money is starting to go into other sectors in the market, I do foresee the markets continuing to rise into the end of the year. It will not be a straight line. We may have a correction, like we said in October, and if there is one, it'll probably be short-lived because there's so much liquidity on the sidelines. They're looking to pounce in. Mm-hmm. People are missing out on this rally. It's called fear of missing out, FOMO. It's the FOMO effect. Once again, I'm reliving the FOMO effect, and I foresee the markets, like I said earlier, continue to rise, but never in a straight line. So the key in all this is to hold quality investments, have a properly diversified portfolio, and always manage the risk within your portfolio.
Thank you so much, Kareem, for answering all of these questions. And I want to thank you for listening to our quarterly web capsule. And I just want to remind you before the end that if you have any questions or if you would like to book an appointment with us so we could review your strategy and your portfolio management, we will be more than happy to do so. So don't hesitate to reach out, and I wish you a great day.
Thank you.